Hello, in this video we'll be talking about corporate taxation, specifically corporate operations. Now whenever I do a video on corporate taxation, it's always important to think about the big picture where this specific video fits into play when it comes to the life cycle of the actual corporation. So the first topic and the first item on the life cycle is corporate formation and contribution. Next would be corporate operations, the normal day-to-day operations, and that's what we're focusing on in this video. So the normal tax issues. Other corporate operations issues include distributions, redemptions, and stock distributions, which also merit their own discussion. Finally, the last topic is usually corporate liquidation because that's winding up the corporate affairs, and we consider the tax consequences of corporate liquidation. So let's go into the specifics of corporate operations. So the starting point I like to do with the normal corporate operations is to compare and contrast the individual tax structure, individual income tax structure with the corporate income tax structure. So on the left here, we have the corporate tax Form 1120 structure. On the right side, we have the Form 1040 individual structure. Now, what you're going to notice is there's some similarity, but there's lots of differences. So under the tax law, the way that the income tax rules under Subtitle A of the Title 26 of the U.S. Code, so the income tax subtitle, the general rules apply to all taxpayers. However, there are some differences that apply to specific taxpayers. For example, individuals might get certain deductions that only apply to individuals, like medical expense deduction or moving expenses, those kinds of things. Corporations also have special provisions that only apply to them. For example, the dividends received deduction only applies specifically to corporations. You're not going to see that anywhere else. So keep that in mind. But again, the main thing is that when you learn about income tax rules, the starting point is always the same rules. Section 61, what's gross income? Various exclusions. And you see that's both the case for corporations and individuals. So you'll see we have lots of similarity there in determining the gross income amounts. So that gives us gross income. This is where we start to have deviations. So when it comes to corporate deductions, there's no distinguishing factor between adjusted gross income, or deductions for adjusted gross income, I should say, and deductions from adjusted gross income, also known as above and below the line deductions. So you'll see that for individuals, we have those differences. Deductions for AGI, and then we have itemized deductions, and then we have the qualified business income deduction, both deductions that are deductions from AGI. Again, deductions for AGI are also known as above the line deduction because it's above the line for AGI. Below the line deductions are itemized and the deduction for qualified business income that go below the AGI amount. Notice again, as I mentioned, that for corporations, there's no difference. If you have a deduction, it just reduces income. So we have gross income, and then those deductions will reduce gross income. Now, we might have those deductions at different places on the Form 1120, right? So we have the Form 1120 for the corporations, specifically C corporations, and individuals, we have the Form 1040. The Form 1040. So on the Form 1120, we'll reduce gross income with deductions, but again, we don't have that same type like the individuals where we have different types of deductions. Now again, for corporations, deductions might be in different places, but it still has the same effect. You might recall that from individual income tax, being a above the line deduction versus below the line deduction is important for two reasons. First, deals with limitations. There are limitations on below the line deductions that deal with AGI. You don't have that same case for deductions for AGI. The second is that when you have a below the line deduction, generally speaking, itemized deductions, not the deduction for qualified business income under Section 199A, it's the greater of the itemized deductions allowed or the standard deductions. You don't have that issue with the above the line. So again, we don't have that same breakdown and dichotomy with respect to above and below the line deductions for corporations. That gives us taxable income, which we have taxable income. We take away tax credits, we calculate our tax due, and we have tax due or tax refund. So there are some similarities, there are some differences. Now, the rest of this presentation is going to focus on the main differences when it comes to corporations versus the general rules. Specifically, types of deductions and other issues that only apply to corporations or have special rules to corporations. So that's very important to understand. So let's go ahead and take a look at that. So whenever I deal with an income tax issue, if I'm given a fact pattern, if I have a client issue and it's an income tax issue, there's always 5 questions that I look at. What amounts gross income, if any? What amounts deductible or credits, if any? What is the character of the attribute, so characterization? When is the amount included or deducted or taken as a credit? And who? Who must include, deduct, or utilize the amount? So here are the timing issues, the when question. Here are the characterization issues. And here are the deduction issues that we're going to focus on in this presentation. Now, I do have some other discussion at the end of the presentation, but these are really the main highlighting points, the major differences when it comes to corporate taxation, corporate income taxation from the rest of income taxation. We're going to take a look at all 3 of these classes, when question, characterization question, and deduction question, separately. But within these different classes of questions or issues, you'll see that we have breakdown. This serves kind of like an outline. So let's go through. Let's start with the timing issues. So timing issues. We're talking about the when question. So the first thing that we need to look at is the accounting period. Accounting periods. So most C corporations can either be a calendar year, which is January 1st to December 31st, or fiscal year end. Fiscal year end, which means other than calendar year. Depending on usually the type of business. Different industries usually have different types of year ends. So for example, in the accounting industry, lots of businesses have June 30th fiscal year ends. You'll have some retailers that have year ends that might end at the beginning of the year, maybe around January, just because they have lots of stuff going on. Various types of industries. You might have a Halloween store that closes its books on October 31st, because that's when that's when its main business ends. So it's really a factor of the actual industry. Now, S corporations and personal service corporations are more limited. Okay, more limited. This is where I want to stop and talk about C corporations versus S corporations. So C corporations, as many of you know, are subject to double taxation. The double taxation element, the first level of tax is at the entity level in the Form 1120. The second level is at the distribution level. Now, C corporation is that normal general corporation that's subject to double taxation. S corporation, though, S standing for small business, and also refers to subtitle S of the income tax provisions. Only one level of tax allocated out to the owners. Same with partnerships, very similar structure for tax purposes. The C corporation, subject to double tax. The C doesn't really mean anything. What it means is it refers to subchapter C of the Internal Revenue Code. If I said subtitle S, by the way, earlier I meant subchapter S of the income tax provisions in the Internal Revenue Code. So S corporation, small business corporation, that's what the S stands for. Also found in subchapter S for S corporation in the income tax provisions. And then C corporation found in subchapter C of the income tax provisions. So I just want to lay that out there. Because we're going to see lots of talk of C and S corporations throughout the discussion. So that's really the accounting period. Not too many issues. The idea there is that businesses can be either calendar year or can be fiscal year end, which is other than calendar year. Accounting methods, very important. The when question in tax is extremely important, especially when you're thinking about things like time value of money. A dollar today is worth more than $1 in the future. Same idea of tax savings. $1 of deduction today is generally worth more than $1 in the future. And the reason I say generally is because I'm holding aside issues like maybe the tax rates will change. Assuming the tax rates stay the same, taxpayers still in the same tax rate, $1 of tax savings today is worth more than $1 of tax savings in the future. So accounting methods affect that. There's 2 major accounting methods, but there's also some combination of those. We're just going to focus on the 2 main. There's the cash method, mentioned here, the cash method, and there's also the accrual method. So the cash method, the taxpayer includes in income any revenue when it's received in terms of cash payment. Records expenses when they're paid. The accrual method, which is the other type, so we have cash versus accrual. Again, cash, we record revenue when it's received, expenses when expenses when paid. Accrual, we record revenue or income when it's earned. You have an economic right. And then we record expenses when they're incurred. Okay, so there's a liability that arises with respect to that expense. Hasn't yet been paid out, but somebody has a right to that. So generally speaking, the cash method of accounting is unavailable to corporations, except for S corporations, corporations that are involved in farming or timber industry. Farming and timber sometimes get special carve-outs. Qualified PSCs. So you're wondering, what's a PSC? Personal Service Corporation. So lots of attorneys, lawyers, accountants that have businesses. If they create a business and it's a corporation, it might be subject to the Personal Service Corporation rules. And finally, the last one, corporations with average annual gross receipts of, and this is $25 million. $25 million or less for the most recent 3-year period. Now, the reason I have this blank and I have others blank in this presentation is because these numbers change frequently. At the time of this video, it's $25 million, but it could change in the future, so be careful. Check this number. So you go check this, but $25 million at the time of this video. In the past, it was a different amount. It's $25 million at the time of this video. So these are corporations that can get the cash method. Now, another thing. So if you're a C corporation, which is what we're focusing on when we discuss these topics, or any corporation really, you cannot get the cash method. Must be accrual method. You can get cash method if you're an S corporation, farming, qualified personal service corporation, or you have average annual gross receipts of $25 million or less for the most recent 3-year period when you're looking at, again, the average. Okay. Another item. Corporations that maintain inventory. If you do the $25 million or less test over the last 3 years, but you focus on the gross receipts. So if gross receipts are are more than $25 million for the last 3 years averaged, and you have inventory, you're required to use the accrual method. Required to use the accrual method of accounting. Required. Okay, so that's another example where you must use the accrual method. If you aren't required to use the accrual method, you have the option of doing the cash or the accrual method. You have those options. So that is the cash versus the accrual method. So there's some additional issues when it comes to accounting methods. Now, if your company has financial statements that are reported and they're audited, you have to worry about when the financial statements actually report income. If the financial statements report income earlier than how you report it for tax purposes, the rule is that you must include based on the financial statements. So that means you're going to have to record income earlier. Now, again, this is the when question. So it's all about, you're looking at the timing when something's recorded. It's not like you're recording more income than you would. It's just when you look at it over time, you might have more early on, less later on. The next thing is a special election. So this is an election where certain taxpayers, certain corporations, taxpayers really, but applies a lot to corporations, can defer income inclusion of advance payments for goods and services to the end of the tax year following the tax year of receipt. It's a special rule. I also like to talk about related parties. There are special rules that deal with related parties. So if you have an accrual basis corporation, or taxpayer, but usually you see this a lot of corporations. And at the end of the year, there's a related party. Maybe there's an employee that owns more than 50% of the stock of the corporation. Related party. Where it's a cash method related party. And the corporation accrues an expense, but the cash method taxpayer doesn't receive the money until the next year. Well, what's going to happen is the corporation basically is going to be put on the cash method for purposes of that respective example. So here is a specific example. On December 31st of 20X1, think of it as year one. Citrus Corporation, which is an accrual method taxpayer, has accrued a $5,000 bonus to Lemon. Now, let's say Lemon is an individual, cash method individual, that's also a related party. A related party. How might Lemon be related? Maybe Lemon is a 60% owner of the corporation. So this $5,000 bonus, because let's say Lemon is both a shareholder and employee, Lemon receives this in January of 20X2. 20x2 and reports it as income because Lemon is a cash method on Lemon's 20x2 Form 1040 tax return. So here's the issue. Because Citrus is an accrual method and has accrued the bonus in December 31st, 20x1, Citrus is going to record that under the general rules in 20x1. But Lemon records it in 20x2. Because they're related parties, and because one's the accrual and one's cash method, the tax law basically is going to put Citrus Corporation, it's going to basically change Citrus Corporation to the cash method for purposes of this example. So what does that mean? Citrus Corporation, you're not going to be able to take it in 20x1 when it's accrued. You're going to be able to take it in 20x2 when it's paid because it was received in 20x2. That's when Citrus Corporation paid it. So even though Citrus Corporation accrued the bonus in 20x1, right, December 31st, Citrus must claim this $5,000 bonus as a deduction in 20x2. So again, basically the tax law puts Citrus Corporation, for this purposes of this example, on the cash method in order to make Citrus Corporation report this in 20x2 rather than 20x1. Interesting. It's basically the matching. This is an idea of the matching principle. We're going to match. We have some related parties. It'd be too easy to play around with this, so we're going to have to match. Okay, so now we're moving from timing issues, the when question, to characterization issues. So as I mentioned, the best way to understand some of these major points when it comes to corporate operations is many of you already know the tax consequences for individuals and how that works. So we're going to be addressing the corporate by focusing on the individuals and then kind of saying what's different. So capital gains and losses, everybody's favorite topic. And the reason why is because many people know that capital gains and losses can create preferential, if it's a long-term capital gain, can create preferential tax rates. This has historically been the case. So individuals, they do get the long-term capital gains, so net long-term capital gains, they get the benefit of preferential rates. So this could be, at the time of this video, but this could be different when you're watching it. At the time of the video, the highest ordinary tax rate is 37%, and the highest long-term capital gains rate, not including the net investment tax issue, is 20%. So you're talking a 17% reduction in taxes. Big difference. When you're dealing with $1 million, that's $770,000. It's a big difference in taxes. So that's one thing. But let's go down the list. So individuals, capital gains and losses, the rules are capital gains can be offset by capital losses. A net short-term capital gain is subject to regular ordinary tax rates. And net long-term capital gain is subject to preferential tax rates. Again, we just talked about that. Now, net capital losses for individuals, after offsetting capital gains, you can also use up to $3,000 against ordinary income. I have this amount here because, again, it could be different. And also, there's also two numbers. $3,000 for general rule for taxpayer, unless you're married filing separate, and that's $1,500 against ordinary income. And the remainder carries over to future years. So a carry forward. So we've got this special amount here allowed to offset against ordinary income. Now, carryovers do not lose their identity. So if you have a long-term capital gain from a transaction, if you have a long-term capital loss, my apologies. If you have a long-term capital loss, and you use against ordinary income, but you still have some left over, it's going to remain a long-term capital loss when you carry it over next year. Same with short-term capital loss. Maintains that short-term capital loss character for next year. So very important. If we look at corporations, so the first thing is that capital gains still offset capital losses. That's the same. But here's where we change. Corporations are, everything in a corporate tax is subject to the same rate or rates. It's all subject to the same corporate tax rates. There's no preferential treatment for long-term capital gains like we had for individuals. Whoa, big difference. Yes, it is a big difference. And that's very important to understand. Corporations do not have a special characterization, long-term capital gain, short-term capital gain, long-term capital loss, short-term capital loss. It's all treated the same like ordinary income. Now, you might be wondering, well, why do we even worry about capital gains, capital losses for corporations then? Why don't we just classify everything as the same character? That's a great question. The reason why is, as you know, capital gains can only be offset by capital losses. So we're not able to basically commingle the ordinary income with the capital losses and offset it. We carry forward those or carry back those separately. All right. Another thing, corporations do not get that special benefit where you're allowed to offset against a certain amount of ordinary income. We saw for individuals, it was $3,000 unless you're married filing separate, $1,500. Guess what? Corporations do not get that. They only can use capital losses to offset capital gains. Whoa. Okay, big change. Big change, but that's important to understand. Another thing, individuals carried forward all capital losses, whether it's short-term or long-term, carry them forward indefinitely until the person dies, and then they're gone. For corporations, we carry them back 3 years and carry them forward 5 years. So carry back 3, I left this blank, carry back 3, carry forward 5. And then all carried over losses are treated as short-term capital losses. So all capital losses that are carried back, carried forward, treated as short-term capital losses. Very important. Okay, very important. So that's a change as well. So we've got lots of changes here. Lots of changes. Okay, so you might recall depreciation recapture. That's a characterization issue because the idea there is that you're getting, when you take depreciation deductions, you get benefits at ordinary deduction rates, and then you come in with Section 1231 or capital, and you get this preferential rate. Well, for corporations, not as big of an issue, but we still have to worry about that. So still the same. So Section 1245, Section 1250, under capture Section 1250, boom, all still applies the same. However, there's a new rule. New sheriff in town, new rule in town when it comes to depreciation. In addition, we also have Section 291, which has an additional. So corporations have even more recapture. Additional ordinary income recapture equal to 20% of the excess of depreciation recapture that would arise if property was Section 1245 over depreciation recapture computed under Section 1250. That's very interesting. So that is basically saying that corporations almost always are going to have more depreciation recapture issues because of this special provision. Okay, so we are done with characterization, right? We're done with characterization issues, right? Woo! Moving on. Going on to deductions. Now we've got lots of deduction issues to consider, so let's go through this. Now, first thing I want to mention before we actually break it down with each one is that you're going to see there's lots of taxable income limitations in these deductions. Each taxable income limitation on each deduction, you have to calculate based under the law for that provision. So they're going to be different. Whether it's the business interest expense limitation, taxable income, whether it's the dividend received deduction, taxable income, there's other ones out there. But you have to look at the specific provision because they're calculated differently. So the first thing we have here is the business interest expense limitation, also known as Section 163J. Section 163J of the Internal Revenue Code. Now this provision, it limits the amount of interest expense that a business can take. Well, you're saying, well, why is this specifically here for corporations? And you're right, it applies to all businesses. Whether you're a sole proprietorship, Schedule C individual on a Form 1040, whether you're a partnership, whether you are a S corporation, C corporation, a REIT, doesn't matter. It applies to all business entities. It applies to all business activity. It's called business interest expense limitation. So you are right. Now, this specifically limits the deduction for business interest expense to the sum of the taxpayer's business interest income for the year, 30% of the taxpayer's adjusted taxable income. Wait, hold up. Remember, I just mentioned that adjusted taxable income is calculated differently for all these different provisions, so we're going to have to examine that in more detail. And the taxpayer's floor plan financing interest for the year. So, number 1 and number 3, they're quite unique to situations because you're not going to have a lot of taxpayers that have business interest expense where they also have business interest income and floor plan financing. Now, any amounts that are disallowed because you're limited are going to be carried forward and used in future years. So you are allowed to carry forward. So this is really a timing issue in terms of when you can take, but it's still a deduction provision, a limitation on it. Now, one thing I want to mention is that when you're dealing with this provision, right, the business interest expense limitation, This does not apply to taxpayers with average gross receipts for the prior three-year period of $25 million or less. That's $25 million, okay? I want to put that in there. $25 million or less. You're seeing this $25 million 3-year period gross receipts, average gross receipts. That's come up already like 3 or 4 times. That's a very common amount, okay? It's $25 million, average of the last 3 years, gross receipts. You know, you look at those things. One thing I want to mention is that why do we even have this provision? So one issue is debt versus equity. So as many of you know, if you are financing your corporation and you are trying to raise capital, you can do so through either equity, so you actually give out ownership, or debt, where you have to pay back money, but you're using the capital to obviously do whatever you need with your capital funding. You obviously have to pay back the debt, not required to pay back the equity. Now, the interest expense on the debt is deductible, and that's usually where we get into this issue. Now, there's been an issue that's been in the Internal Revenue Code for a long time, even more so since 1986, the 1986 tax code. But again, debt allows for interest deduction. Equity allows for distribution, which if you see my distribution videos, you cannot deduct distributions, whether they're dividend, return of capital, capital gain. The corporation cannot deduct that. So that's very important. So if you're a corporation, you're going to want to try to classify the investment vehicle as debt or bond or loan or whatever, because you get to deduct the interest expense, which is what you're paying out. And people do crazy things. They'll do this. So that's what this provision really gets at. That's one of the driving forces. People were misclassifying certain things as debt when they looked more like equity, because maybe they had a component of, we're going to pay you interest based on net income. What? That's got to be equity, and it is. We look at these factors tests for debt versus equity, but that's going to be an example where that's definitely equity. So the idea here is that when it comes to debt, we get to deduct debt. Equity, we can't. So people misclassify so they get the interest expense, especially remembering that corporations are subject to double taxation. And if you can reduce your taxable income at the corporate level, you can actually get rid of double taxation. So people will do this. So to put a hurdle or put a stop to this main issue, Congress put it into play, this rule, to limit the amount of the interest expense that will be deducted. And with the debt versus equity fiasco, we'll call it, misclassifying, that even it lessens the ability for people when they misclassify to get this benefit. Again, it's all a timing thing, but still, it hurts the potency because you can't take it immediately. So the thing I really want to focus on is the 30% of the taxpayer's adjusted taxable income. So on the next slide, I have adjusted taxable income. And you're going to see a lot of times that, whether you're taking the CPA exam, a law school exam, whatever it is, you're in practice. If you're in practice, you're going to have to calculate this. Very important. The regs, when this provision came out, 400 to 500 pages. And a lot of it dealt with what exactly is adjusted taxable income, or how are these rules going to work to calculate the 30% of adjusted taxable income. So you'll see that taxable income is computed without regard to non-business income, gain, deduction, loss, any business interest, any net operating loss, any Section 199A, and this is important, depending on the year, it could be earnings before interest and taxes, or it could be earnings before interest, taxes, depreciation, and amortization, EBITDA. Because right here, any deduction for amortization or depletion. So this last point, depending on the year, might be part of that. Now, EBIT is going to be usually smaller than EBITDA because that means depreciation and amortization has been taken out, which you want EBITDA because 30% of EBITDA should be a larger number because it's before interest, taxes, depreciation. So here I have EBITDA because it's saying taxable income is computed without regard to, which means we do not subtract away depreciation, amortization, or depletion when we do EBITDA. But in future years, or depending on the year, it could be EBIT where we do take into account these things. Gotta pay attention. I want to bring that point to you. Okay, passive activity loss rules. So you've all heard about the passive activity loss rules to get at tax shelters. Well, tax shelters didn't really involve corporations. So almost all corporations, specifically C corporations, are not subject to passive activity loss rules. Not subject to those rules. Not subject. Now, of course, we know individuals, S corporations, partnerships, and closely held C corporations are subject. They are subject to the rules. Very important, especially when you consider, again, the tax shelters, especially the ones that went on in the 70s, 80s, and how Congress came in, put in Section 465, 469, passive activity loss rule, Section 469 comes into play to limit tax shelters, pretty much puts a stop to those, and it had a lot to do with these types of entities. Individuals, personal service corporations, especially the S corporations, and boom, the big one, the limited partnerships or the partnerships, and then closely held C corporations are subject, okay? But not all the rules for closely held C corporations. But the main thing is that most C corporations are not subject to passive activity loss rules. Okay, continuing on with the deduction issues. The next topic is charitable contributions. So, unfortunately, I have to say that charitable contributions for corporations, they still are that large headache you might recall from individuals. So, amount deductible for property contributions depends on the type of property contributed. So you might recall that, depending on the type of property contributed, whether it's cash versus long-term capital gain property versus capital loss property versus ordinary property, and depending on who you give it to, whether it's to a qualified charity, a non-qualified charity, a private foundation, it all has these special rules. Just like for individuals, corporations also have to worry about those. Now, we're not going to spend time talking about that because, again, we focus on things that might be different for corporations to bring attention so you know how to specifically deal with these situations. One main thing is that corporate and non-corporate taxpayers may deduct charitable contributions in the year paid. We know that. Now, accrual basis corporations have a special rule that says that if the board of directors authorizes that a charitable contribution will be paid out, this is by the end of the year, and it's paid before the filing date, the due date of the corporation's tax return, which is, we'll learn more about this later on. It's the 15th day of the fourth month following the close of the tax year at the time of this video. Could change. It's been different in the past. So if you're a calendar year corporation, that means April 15th. And you can have an extension on that. But it's the regular date. It's the regular due date. So the idea here is that if the board of directors, they authorize to a charity that they're going to pay out at the beginning of the following year. They do this at the end of the year. Maybe they're a calendar year corporation. They do this in December, right? For the holidays, for United Way or some other charity. And they say, you know what? We're going to go ahead and approve. We're going to authorize that in middle of January, January 15th, we're going to pay out $1 million charitable contribution from the corporation. Well, the idea is that if it's authorized by the board of directors in that first year, even though paid in the second year, it's going to be deductible in the first year, which, remember, generally speaking, time value of money, we want to be able to deduct that earlier rather than later. Again, there's exceptions. We might want to take it later because tax rates change or things like that, or expiring NOLs. But really, that's the idea. So another thing, I mentioned taxable income limits. So again, charitable contributions have their own specific taxable income limits, which are taken into account before these three things. And here's a big thing to note, and I definitely want to emphasize this. There are, again, lots of limitations when it comes to charitable contributions. A big one, sorry, it's up here as well, is that for corporations, in addition to the other charitable contribution limitations, are limited to 10% of taxable income based on this calculation. You can't go beyond that. Any amount that's limited can be carried forward for 5 years. For 5 years. Okay, 5 years. Okay, excessive executive compensation. So, publicly traded or publicly held corporations have special compensation rules because certain entities were getting greedy. They were paying their CEOs, highest paid C-suite executives, a lot of money. IRS was questioning that. And again, a way to reduce double taxation is to pay out compensation because that reduces your taxable income, and then you don't have double taxation because it's not subject to tax. And it might be single taxation because you're paying out to the employee, who could also be a shareholder. So currently, at the time of this video, and this could change, the tax law limits the deductible amount to a publicly traded corporation or publicly held corporation to any covered employee defined below, to $1 million annually. No more than that. Covered employees include principal executive officer, so CEO, principal financial officer, so CFO, and the three other most highly compensated officers. Could be the COO, chief legal officer, depending on the entity, of course. But usually the CEO and CFO are some of the highest paid, so they went ahead and put that in there. In general, this $1 million limit applies to the following: compensation, commissions, performance-based compensation. Notice there's nothing in here about fringe benefits, or deferred compensation, or retirement, or what about stock options? Oh, interesting. So maybe that's how they get around this, or they go through that. But again, the key is that it can't just be through straight compensation, straight bonus, that's performance-based compensation, or just straight compensation. NOLs, net operating losses. So when a corporation has a negative taxable income in a year, it could roll that over in the future because NOLs are carried forward indefinitely. They're carried forward. In the past, they were carried back, but now they're carried forward. Also, NOL deduction for any carryover year is limited to 80% of taxable income. And again, taxable income could be is calculated depending on the specific provision, just like we saw with some of the other things. So you have to look at that. So that's important to understand. Remember that capital losses they carry over differently. NOLs carry over differently as well. So we have lots of carry back, carry over rules, carry forward rules, and this is one specific. All right, one of my favorite topics, the dividends received deduction, the DRD. Not to be confused with DDR, right? Dance Dance Revolution, very popular game. I myself have enjoyed that game a little bit. Dividend received deduction. What is this all about? So if a corporation, has to be a corporation, okay, has to be a corporation. If a corporation owns stock in another corporation, key in on that. So a corporation, we usually denote that by a square or rectangle. It's a rectangle. So we'll say Corporation A. I know my rectangle kind of looks like part of the state of Oklahoma there, right? Sorry about that. It's supposed to be a rectangle. If Corporation A owns 100% of Corporation B, and Corporation B pays a dividend to A, let's say a $1 million dividend, the issue there is that there's 3 levels of tax. B pays tax, the first level on the Form 1120, B's 1120, distributes that out, okay? When A takes that in, Corporation A takes that in, that goes on to A's Form 1120 as gross income. That's the second level. And then guess what? If A distributes that out to A's owners, let's say they're individuals, that's going to be a, boom, third level of tax. Oh my, we've just gone from double tax to triple tax. So in order to alleviate more than double taxation, Congress created this rule, the dividend received deduction rules. And these rules, what they're going to do is they are going to provide the ability to lessen that more than double taxation. Now, we do look at the ownership. Again, a corporation here, A owns B. Corporation must own stock in another corporation. We look at the ownership. That's important. If it's less than 20%, it's going to be a 50% deduction percentage we use. If it's between 20% and less than 80%, we use 65%. And if it's 80% or more, which we know is control in the corporate tax rules, remember we learned that in Section 351, 100% deduction percentage. Okay? If those are the percentages that we use, just so you know. We're going to use that percentage. We're going to include in our income. So A is going to include the $1 million in income, in A's income, but A gets a deduction later on down the Form 1120, depending on the percentage, based on that dividend or based on a taxable income limitation. So there is a taxable income limitation, okay? It's limited to a taxable income limitation. So I have some rules that will help you guide you through this. So I kind of have some rules of thumb, and then I have some steps. And then we have some examples to show you how this works. When you go through examples and you do it, it really helps you. So if the dividend received deduction, if the dividends received are less or equal to taxable income. So if dividends received, not dividend received deduction, dividends received, DR, is less than or equal to taxable income, we're going to multiply the dividends received by the deduction percentage, which we just mentioned, by the deduction percentage, okay? If the dividends received are greater than taxable income, then it depends. It depends on one or two possibilities, okay? Think of it like a decision tree, one of two possibilities. If the DRD creates or increases an NOL, we're going to multiply by the dividends received amount, the DR amount. But if a DRD does not create or increase NOL, we're going to multiply by taxable income, the taxable income limit by the percentage. Multiply taxable income by the percentage. So really to solidify this, I have 3 steps. Step 1, multiply the dividend received deduction. Multiply the dividends received. I keep doing that, sorry. Multiply the dividends received by the deduction percentage. Okay? That's from our little table we talked about, right? It's 50, 65, or 100%. Step 2, multiply taxable income, the taxable income limit, by the deduction percentage, 50, 65, or 100%. And finally, subtract number 1 from taxable income. So we always do number 1 when we're doing this. And that's how we get our result. If we subtract number 1 from taxable income, and it creates or increases an NOL, then we're going to use number 1. If we subtract number 1 from taxable income and it does not create NOL or increase an NOL, we're going to use the lesser of number 1 or number 2. Okay, lesser of number 1 or number 2, depending on the situation. Okay, so let's take a look at an example and apply these rules, these steps, which are also, it follows the rules I've created for you. So we've got Red, White, and Blue Corporation, right? Woo! Go USA! So Red, White, and Blue Corporation, we've got gross income from operations. That's from operations. That does not include the dividends received. We've got expenses from operations. We've got dividends received. Now note that in all 3 of these situations, Red, White, and Blue, they all own the same exact ownership. It's less than 20%. If you really want me to be more concrete, let's say they own 15%. Let's say that Red Corporation owns 15% of this corporation at issue. Okay, we'll call it USA Corporation. White Corporation owns 15% of USA Corporation, and Blue Corporation owns 15% of USA Corporation. Now, we're not dealing with the other corporations because obviously that equals 45%, so there's 55% more. We're just focusing on Red, White, and Blue. Taxable income before dividends received deduction. Okay, let me show you how we get this number, because you might have to do this in your own calculating. Of course, in practice, we take the gross income from operations, $400,000. We also add to that $200,000 dividends received, because that's not in the operations. That gives us $600,000. We subtract away the $340,000. $600,000 minus $340,000 is, boom, you got it, $260,000. So that's where we get that number. You can do the same thing for White Corporation and Blue Corporation. Okay, so a few things I want to note before we go on to the next page where we do the calculations, the 3 steps, and we actually get our result, applying the 3 steps and also our rules that we've learned. So first thing I want to note is that for all of these, we have less than 20% ownership, right? Again, for our example, let's just assume they own 15%, because usually you're going to have a more concrete percentage, which is less than 20%. That means for all of these, they all are going to have the 50% applicable percentage. Whether you're doing rule 1 or 2, all of them are 50%, right? Because it's between 0 and less than 20%, 50%, equal to 20% and less than 80%, 65%, and then 80% or more, boom, you got it, 100%. So we have 50%. That's what we're going to use for step 1 and step 2. Now, for step 1, for all of these, it's going to be the same. It's going to be 200,000 times 50%, which equals, that's a 50, by the way, that's a 50, not a 58, okay? So 200,000 times 50%, we have 100,000, okay? It's 100,000. That's 100,000 for each of these. So you're going to see 100,000 in the next slide. That's how we're getting the 100,000. Step 2 is to multiply these numbers all by 50%. So we're going to see 260 times 50% is 130. 180,000 times 50% is 90. And then 90,000 times 50% is 45,000. Okay? And that's before that. So we go over, we have step 1, boom again, we have our $100,000 amount. $100,000. Okay, step 2. Again, we're taking our percentages, 50%, 50%, 50%. We've got 130 for red. We've got 90,000 for white. And we've got 45,000 for blue. Just showed you how to do that. Now we go to step 3, which is where we do our comparison. So, and again, this follows the rules. So the idea is that we look at the lesser of step 1, which was, again, the dividend received times the percentage, and the taxable income. If the dividend received times the percentage, step 1, is less than step 2, we always are going to use this. We don't even look at whether it creates NOL or not. So because this is less than this, we're going to automatically use that and not even go down here and worry about NOLs. So boom, our result is 100,000. So now we go to white and blue corporation. Now we have to actually have to worry about the NOL. So for white corporation, guess what? We've got 100,000 versus 90,000. Again, these have already been reflected, the percentages, step 1 and step 2. So the idea here is we go back to our previous slide and we look at the taxable income before the dividends received deduction. All right? If we take this number and we subtract away the step 1, $100,000, not step 2, step 1, right? So 180,000 minus the 100,000 step 1, we get a positive $80,000. If it's positive, there's no NOL. Since there's no NOL, that means that we're able to use the lesser of these two. So the lesser of here is a taxable income, and boom, we're going to apply that so we have taxable income. So this is step 1 used. This is step 2 used. So let's look at Blue Corporation. 100,000, we have 45,000. Step 2, right? Our percentage, 50% times 90,000. So if we go back to the previous slide, we've got 90,000 taxable income before DRD. If we subtract away step 1, 90,000 minus 100,000, step 1, we get negative $10,000. We have an NOL. If we have an NOL, again, the rules say that we're going to do the lesser of number 1 or number 2. Okay, deductions limited to that. Okay, I'm sorry, my apologies. Read that wrong. So you got to be careful here, right? That's my example. If we have an NOL, it's always going to be number 1. You're not going to apply the taxable income limit. So because we have 90,000 minus 100,000, negative 10,000, that's an NOL. Boom, NOL. We're going to do number 1 always. We don't even do the lesser of because there's an NOL. So that means the NOL rule kicks in here. NOL rule is always number 1. And we are done. So really, all there is to it, other than that, is just changing around numbers and practicing. That's all you're doing. Not too bad, right? Not too bad. All right. Another topic. Organizational expenditures and STARV expenditures. So you might recall learning about STARV expenditures and individual taxation, right? Specifically when you have like a sole proprietorship and you're considering starting a business or going into a new line of business and you're looking and doing research and you're looking, hey, I'm doing research and finding out the demand, what kind of expenses I need, all these different things. So organizational expenditures are specific to corporations. The rule is that we're going to amortize the organizational expenditures over a 180-month period, beginning with the month in which the corporation begins business. And we use the full month method. So it doesn't matter whether it starts at the beginning of that month or the end of the month, we do a full month for that month. Now, there's a special rule, special carve-out for small businesses. Hey, we always see this in the tax law, right? Small business carve-outs that says the first $5,000 of these costs can be immediately deductible. Immediately, right at that beginning. But there is an exception. There is a phase out because this is a small business, any amount beyond $50,000 is going to be phased out with respect to the $5,000. So once you hit $55,000, guess what? This rule becomes zero. Big zero, right? So as you go down, right, if you go $50,001, this goes to $4,999. As you go down, it reduces. Once you get to $55,000, right, it's like a range. Once you get to $55,000, this becomes zero. So we're at $50,000 here, $55,000 here, right? Anywhere in here with respect to your amount of organizational expenditures is going to qualify for deduction immediately. You also get the 180 month as well, but we're talking about immediately. Special carve out, okay? You're going to get that, but once you hit 55,000, you don't get that. You just do everything over 180 months. So what things qualify as organizational expenditures? What types of things qualify? Let's talk about that. Very important. So legal services, incident to organization, big one here, big boy. So some examples: attorney organizing corporation or drafting corporate charter and bylaws. Necessary accounting services, another very common one. Accounting services to organize corporation. Maybe you're setting up the books. Another, expenses of temporary directors and of organizational meetings of directors and shareholders. And finally, here's probably the most that we know when we think of organizational expenditures, and that's fees paid to the state of incorporation. So if you're filing your articles of incorporation with the state of Delaware, organizing your corporation, all that stuff, you pay a fee. Guess what? That gets added into organizational expenditures, and boom, we apply those rules. 180 months, or you can do the $5,000 immediately. Again, it's limited though. What types of things aren't organizational expenditures? Well, any expenditures connected with issuing or selling shares of stock are not considered organizational expenditures. So perfect example, printing off stock certificates. If you're printing out stock certificates, that cost is not going to be an organizational expenditure that can be amortized or immediately expensed. Instead, that's just going to be, it's just going to be added into the costs. Okay, it's going to be added into the cost of the business. Probably stuck there. Just like if they held land forever, right? That basis is stuck there. Let's take an example. Lime Corporation incurs $53,000 of organizational costs. Look at that, I'm nice. I've already given you what the organizational costs are, but you might actually have to go through and figure out what organizational costs are. So make sure that previous slide walks you through how to do that, right? I gave you some examples, the types of things. Those are what go into organizational expenditures if you ever have a question. And again, what are not, do not go in there. So we have $53,000 of organizational costs. In December, 20x1. Lime is a calendar year C corporation. So let's talk about what Lime can do immediately. We've got that $5,000 special rule. That's the first step. So step one, consider the $5,000 rule. So here it's $53,000. Guess what? We are within that range. We've got $50,000, right? That's where it starts. By the way, if you have less than $50,000, you're still fine. But you can only take up to $5,000. Okay? If you have less than $5,000, you can only take whatever amount you have immediately. So between $50,000 and $55,000, we're what? We're here, right? We're somewhere in the middle there. Well, not the middle, obviously. We're 3/5 away. We're 53,000. We're partway through that table, right? So we're going to get a portion because it's not fully phased out because we're not $55,000. So the way we calculate this, we take the $5,000 amount and we subtract away the amount that's been phased out, which is the $53,000 minus the $50,000, which is $3,000. So $5,000 minus $3,000 is, boom, you got it, $2,000. So $2,000 is allowed to be deducted right now, immediately. Special carve out for small businesses. Boom. We've got $2,000 right there. Okay, what about the other $51,000? We just took $2,000 and the $53,000. The remaining $51,000 is amortized over 180 months. Straight line. We're allowed to do the full month method. Well, this is a calendar year C corporation. Calendar, right? We've got a calendar year C corporation. That means they're January 1st to December 31st. So we've got 3 months to worry about. October, November, December 20x1, because we're focusing on how much can we take in 20x1, okay? So in 20x1, we're going to do 51,000 remaining over 180 months, so that's the total life, times 3 months. October 20x1, November 20x1, December 20x1, 3 months, boom. And that gives us $850. So step 2 is then to apply the normal general rule of 180 months to see how much that year. Finally, step 3, we add together step 1 and step 2, which gives us $2,850 in this year. And then, of course, in 20x2, the next year, it'd be 51,000 over 180 months times 12 months, and that would give us the amount, which is around $3,400, I believe. Yeah, it sounds about right. $3,400. STARV expenditures. So organizational expenditures deal more with things like actually, incorporating the business, accounting fees, legal fees, paying promoters, those types of things. Paying state fees, again, not issuing stock certificates. STARV expenditures, which again you might recall from individual tax, deal with investigating expenses involved in entering a new business. If you're already in a business line, then it would just be a normal trade or business expense, and you could deduct it immediately. But if you're not, then you're dealing with the issue of it's not deductible under Section 162 trade or business because you're not carrying on an existing trade or business. So some examples, right? Let's say that you are, and there's actually case law to support this. Let's say you're in the hotel business and you have hotels in Miami Beach and you're interested in looking at hotels in Lake City, Florida, which Lake City, Florida, if you've never been there before, what you're doing is you're just traveling on 75, probably between Atlanta and South Florida or Florida to go to vacation. You're talking about Miami Beach hotels, resort type hotels, destination hotels versus Lake City hotels on I-75, which are going to be travel hotels. You're just staying the night because you're tired and you need to rest your eyes and you can't keep driving. You can't drive more than a certain number of hours. So the case law, actual tax law has said that these are two different types of businesses. Two different lines of businesses, going from the resort hotels to travel hotels. So if you're in the resort hotel, Miami Beach, and you're going in, now you're looking to get into the Lake City travel hotels, you are now investigating a new line of business, a new business. So that would be, your potential expenses would be STARV expenditures. So things include travel, market surveys, financial audits, legal fees associated with, connecting due diligence, those types of things. Also can include other types of things, but those are the main ones. Now the idea here, guess what? We've already done the calculation. It's exactly the same as we did for organizational. For org expenses, exactly the same. Easy. We've got the immediate $5,000 step 1, boom. But remember, it's phased out after $50,000. So we've got that same range between $50,000 and $55,000. It's phased out beyond $55,000, right? It goes down $5,000. And then the remaining amount is amortized over 180 months. So that exact same example we had of Lime, you could change that around, put in some STARV expenditures, boom, calculate the same way. And again, this is also available to non-corporate taxpayers because you might have seen it in other individual areas. Okay, so now we've gone through and identified really the timing issues, the deduction issues, and the characterization issues. Again, those are the really big differences when it comes to corporate versus individual tax. There's lots of other differences out there, but those are the main ones. Those are the big ones, okay? Real big topics. Again, now, take a look at Form 1040 versus the 1120. You might actually want to stop at this point. Remember, corporations file Form 1120, specifically C corporations. Individuals file Form 1040. Go stop the video. Take a look at Form 1040 versus the 1120. Again, you're going to see lots of similarity. The structure and labeling might be a little different when you look at these forms, but you're going to see extremely similar. Things, though, start changing when we get to the NOL and the DRD, right? Those types of deductions are unique. These are unique for corporations versus individuals. And remember, individuals, though, we've got deduction for AGI, and then we have the itemized, also known as deduction from AGI, also deduction for qualified business incomes, and also deduction from AGI above versus below the line. We don't have that here. So there are some differences when it comes to corporations versus individuals. It's important now to kind of dwell on like what you just did. You kind of shedded light on some of those major differences, and you apply the rules that you've already learned with respect to income taxation, but now you're focusing specifically on the major differences for corporations when it comes to operations. Okay, corporate tax rate and procedural issues. So currently, in the time of this video, the corporate tax rate is 21%. However, when you're watching this in the future, it might be a different percentage. So please pay attention to that. In the past, corporate tax rate has fluctuated. It's gone all over the place. Okay, a few years ago, it was 35% progressive rate structure. But currently, at the time of this video, it's a flat 21% rate. Next thing, alternative minimum tax. You all know what the alternative minimum tax from individuals. Alternative minimum tax for corporations, at the time of this video, is no longer relevant. It's no longer applicable to corporations. It is relevant, though, to individuals. Consolidated returns. So, consolidated groups. Entities that own other entities. We saw examples with, Corporation A owning 100% Corporation B. Well, when you have consolidated groups, one corporation will have to report another corporation with a parent 1120 and we have subsidiary 1120. I'm not going to go into those specifics. That merits itself its own discussion, but we're not going to talk about that here. But it's important to understand because if you have a corporate group, you might have to have everything flow through to the parent corporation return 1120. Filing requirements. We just talked about this, or we've talked about this throughout this presentation, but let's continue to talk about it. So again, C corporations file Form 1120. It's due on the 15th day of the fourth month following the close of the tax year, even if no taxable income. Now check that amount or check that date because in the future it might change. It's changed in the past. So for example, calendar year corporation would have to file by April 15th of the next year. Okay? Now, an automatic extension of 6 months is available through Form 7004. This is an extension to file, not to pay. You still have to pay on time. This is an extension to file. Speaking of paying estimated tax payments, corporations, just like individuals, must make estimated tax payments quarterly and all that stuff. Must make estimated tax payments equal to the lesser of 100% of corporation's tax for the current year or 100% of tax for preceding year. And there's no estimated tax payments required if tax liability expected to be less than. That amount fluctuates. It's been $500. It's been different amounts. Check that amount, but just note that that's an issue. All right. The last thing I want to talk about is Schedule M1 versus Schedule M2 versus Schedule M3, which really deal with filing requirements. So we have the 1120, okay? And the Schedule M1, M2, and M3. And by the way, the M1, M2, and M3, these also apply to not just C corporations in Form 1120. They might be on an S corporation, Form 1120S, Partnership 1065, but we're talking about specifically C corporations here. So a Schedule M1, let's start with the M1, okay? The Schedule M1 is where a corporation reconciles financial accounting income with taxable income. The idea here is that you have book financial accounting income, net income, and you have taxable income, okay? And the idea is that you report that book income, but then you have taxable income of different amount. Well, the IRS wants to know, why are there differences in the amount? So the key here is showing those differences. It's all about transparency. If you have aggressive positions or you're showing something, why something's different from your financial accounting income, well, guess what? IRS wants to know why that's the case. So we have what we call differences. We have permanent versus temporary, let me respell that. Sometimes my spelling is not the best. Permanent versus temporary differences. Okay? Permanent versus temporary differences. So an example of a permanent difference is something that either for book purposes or tax purposes we do, but we don't do for the other, and we're never going to reverse that. So perfect example. Municipal bond interest. Not included under tax income. However, it is included on the financial accounting books. It's reported as income. That's something that's never going to reverse. However, a temporary difference is something where it will reverse over time. Perfect example is depreciation. Most businesses, for financial accounting purposes, do straight line for everything. Whether it's equipment, machinery, trucks, land, building, not land, right? Not land. It's all straight line. However, as you know, makers, right? Makers depreciation, a lot of assets could be 200% double decline balance or 200% decline balance or 150%. Some assets, of course, like buildings and others could be straight line, like amortizing intangibles, straight line. But some assets, double decline balance. So from a expense standpoint, earlier on, if you have assets that have double decline balance, you're going to take faster depreciation early on, but straight line will be higher later on because you're going to have lesser depreciation later on. Because the idea is that over time, it's going to be the same amount of depreciation. The only thing that's going to differ is going to be with respect to when it's taken, the when question. So a temporary difference reverses over time. So for tax purposes, you might have lower taxable income because you've taken depreciation and you have obviously double decline balance, but then for financial accounting purposes, you do all straight line and boom, it's going to be recovered ratably over time and you have less depreciation early on, but more later on. So it will reverse. So I talk about all these things here, common reconciling items, and they're all reported. Now, this is important. An M1 is required. Sorry, let's go by not required. An M1 is not required for corporations with less than, and this changes, but right now it's $250,000 of gross receipts and less than $250,000 in assets. So if you have less than both of those numbers, gross receipts and total assets, then you do not have to file an M1. That's not many corporations. Most of those have one of those that's $250,000 or more. So that means pretty much all corporations must file Schedule M1, at a minimum. We're going to talk about M3 in a moment. Okay, next, M2. Schedule M2 deals with reconciling retained earnings, which is a financial statement item at the beginning of the year with retained earnings at the end of the year. It shows what the differences are. Now, Schedule L, which is the balance sheet, and M2 on Form 1120 are not required for corporations with less than, you got it, $250,000 of gross receipts and less than $250,000 in assets. Same idea. Again, that means that almost all entities are going to file M2. M2. Because if you have $250,000 or more of gross receipts or $250,000 or more in assets, guess what? You're required to do M1, M2, Schedule L. And the Schedule L, the M2 deal with one another because M2 deals with retained earnings. Retained earnings go on the Schedule L balance sheet. Finally, the last item, and when we're done with our presentation, is the Schedule M3. So the Schedule M3 is similar to the M1, but much more detail. So here are some common examples you'll see when it comes to taxpayers. You'll see a taxpayer of an M1 and an M2, but maybe no M3. You'll see a taxpayer with all of an M1, part of an M3, and all of an M2. Or you'll have an M2 and an M3. This is usually what you see because, again, not too many taxpayers don't have any of these. That's usually the three you see. So what's common here? M2. All of these have an M2, right? M2 is, again, reconciling beginning of the year with end of the year retained earnings. Shows how that's reconciled. So that's going to be obviously very important. That's the M2. But the M1 and the M3, they kind of do the same thing. They reconcile book income, book net income, right, to taxable income. The idea, though, is the M3 is much more detailed. So it's even greater transparency between the corporate financial statements and tax returns. And it helps the IRS identify corporations that engage in aggressive tax practices. So it's basically the M1, but even more detail. You just don't lump certain things together like you do with the M1. And you go, by the way, stop the video right now. Go look at the Form 1120 M1. Also go look at the Schedule M3, which is an attachment, and take a look and see how it differs. Now, the idea here, again, M3 more detailed than M1. If the entity has total assets of $10 million or more, so at the time of this video, $10 million or more, that's the first line right here. The entity is required to report much greater detail and do the M3. We have to report the Schedule M3. Now, here's where it comes down. Here's where this situation make a difference. So you can do either the full Schedule M3 if you have $10 million or more, or you can always do that. You can always do M2 and M3 like this. Or you can do all of the M1, which is what we have here, and part of the M3. You don't have to do all of it, but there's part of it. I'm not going to go into the details, but there's part of the M3 you must file. If total assets are between $10 million and less than $50 million. Once total assets are equal to or more than $50 million, full M3 is required. So that means that this is greater than or equal to $50 million in total assets. Some of you might be wondering, why not look at total or the receipts? That's usually because if you have total assets of $50 million or more, then you probably have a pretty good amount of receipts too. Maybe not the same amount of receipts, but we're focusing on assets here, okay? Focusing on assets. So, again, let me clarify this. If you have less than $250,000 of gross receipts and less than $50,000, start over. If you have less than $250,000 of gross receipts and less than $250,000 of total assets at the end of the year, or any point during the year, I should say, any point during the year, then you do not have to file Schedule M1, M2, M3, Schedule L, none of that stuff. Very rare though, very rare. A lot of businesses have $250,000 or more of one of those categories. If you have $250,000 or more of one of those categories, you must file M1 and M2 together, and the Schedule L, which goes along with the M2, by the way. It's the balance sheet, which relates to the M2, because that's where you show retained earnings, and you have the balance sheet at Schedule L. Once your total assets get to $10 million or more, you are required to file M3 in some way, somehow. If you have between $10 million but less than $50 million, you can do all the M1, part of the M3, parts of it, which again, there's required parts of it. Okay, I'm not going to go into the specifics. And you have to do the M2. You can always just elect and do the full M3. You can always show more detail. But once you hit $50 million of gross receipts, total assets. See, you got to be careful here. $50 million of total assets. You are required to do the full M3. You can still do the M1, but you at the minimum have to do the full M3 and, of course, the M2. So I hope that helps you understand. If you're having any trouble understanding, again, what I always recommend doing when it comes to these normal operations issues is go look at the forms. Take a look at these issues, okay? Dig deeper into these issues. Of course, this is a basic discussion, but at least it sheds light on the corporate operations, the normal operations. So I hope you enjoyed this video. Please stay tuned or look at more of my corporate tax videos, as they will help you understand the total picture of the life cycle of a corporation.